All right, stock started the week off on a good note. Same kind of positive note that we've always had. In fact, this is the 10th Monday in a row that we've been to the upside. The ninth Monday in a row, we had a very strong day that followed. And we're going to talk about whether that's what we expect this go around or not. The 4 Tuesdays before that one, they were all negative. So we'll see. Are we going to return back to that pattern, or has sentiment changed to where now it's more bullish than it is negative? So we're going to break down the indicators on September 11th, which we all know is not necessarily a national holiday, so to speak, but a very significant and important day for a lot of us. Obviously, some of you may have been actually directly impacted by what happened there, and just about everybody was at least indirectly impacted, as we all remember just how significant that day was, and how important the people that responded, and how important they are, and the heroes that they are, and that should be celebrated on days like today, that we remember those heroes and remember why, and that they sign up for that, and that they're willing to do that, and how grateful we are for those heroes, more so than any of the superheroes that we'll ever watch on TV or on movies. So with that being said, let's go ahead and get started. Today is Monday, September the 11th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video that I do at 3:30 Eastern Time, where I take a look at the old Market Outlook trades, see whether we should stay in them or not. And then we put on today's already before the market closed during that class. Come down here, click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, that it really helps us to get our content out to all of our followers on those platforms. That's why we always ask for that. So our goal is to get up to 100. Again, we got very close in the last video that I did. Brandon's been getting there. So again, thank you to those who do like these videos day in and day out. We really appreciate it. It goes a long way for us. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're back above the 30-day moving average. So a good rally here today, 2/3%. The 10th Monday in a row that we've been higher, not including last Monday because we didn't have a trading session. So 10 Mondays in a row out of 11 that we have been higher now. So really good move lately to start off the week, and that continued to be the case. We talked about that last week with the short-term sentiment trending in that direction, that it was most likely going to be the case again this go around. Today, that's what we talked about in our technical analysis class on Friday, and that ended up being the case. The near-term line rallying above the intermediate line, which is bullish. Those nuances of this particular indicator, the market forecast, that was a topic of our Friday technical analysis class. And so, getting the near-term line above the intermediate line is great. But again, one of both of these things need to happen. Either the momentum line, one or both. So either the near-term line's got to get above 80 and stay there, or both, the momentum line getting above 90 and the intermediate line, near-term line getting above 80. One of those things need to happen. So it's ideal if the momentum line can spike up, right? Because that means we're starting with a good strong move with a big range, and it feels really good. Like, that's the ideal scenario. It doesn't have to be that way, but it's ideal. But you do kind of have to get the near-term line above 80 and stay there. And like you saw even here, even that wasn't enough to get, it was enough to get an intermediate run starting, whereas this one didn't. But it wasn't enough to, we didn't stay there, and so it wasn't able to keep it going. We got right back down in the bearish territory, which kind of thwarted any bullish momentum that this had. So here we are again, back above. So we need to follow through today with kind of what we did the last time. This was the last Tuesday. I tweeted out on this day we were working on the ninth, 9 consecutive Mondays to the upside. But the past 4 Tuesdays were all negative. Not this case though. This last Tuesday of the 29th, the ninth Monday in a row that we were to the upside, that Tuesday was an update. It was a strong update. Got a bear tag and really, really kind of good breakout move. Above a bunch of highs. Great. And then now here we are again. Again, we didn't have a Monday last week, so here we are again with a good, strong Monday. We need to follow up today with that kind of move again tomorrow, because that would get the momentum line up. That would get the near-term line to get to above the reversal zone, just like it did that Tuesday, and then keep it there, right? A very good chance that it would keep it there. So that's the kind of move we need to see tomorrow. We're only 0.5% above the moving average. We did not get a bear tag this go around because we don't have the light green shading, right? The intermediate line is actually still slightly lower. So we're not quite there. So we'll see. We'll see if we end up getting the signal. I don't think we will, but that's kind of what we need to get. I think today is going to be very similar to the 4 weeks that preceded the week of August 28th, where we were more negative, especially considering, again, tomorrow we have Apple, I believe. Is it tomorrow or Wednesday we have the CPI numbers due out? And so this is a big week from an economic standpoint. Even Apple being an individual stock, but its impact on kind of broad, or at least a reflection of broader economic appetite, risk appetite. You're going to see that with this event that's going to be with their new phones being released. So not a whole lot of new, I don't think we'll get a whole lot of new news out of that event, considering that most of it we've already known, and Apple's had ample opportunity to price in what most of what's already known about tomorrow's event. Let's take a look at some of the other indexes. And speaking of Apple, the NASDAQ 100 really benefited from Tesla taking off to the upside today. Its short-term sentiment appears to be trying to get back above the intermediate line and the market sentiment. The near-term line, intermediate line, has been trying to get above the market sentiment for like a week now. Kind of did a little bit, and then it got right back below it, just as by a smidgen. And then now we are looking like we're still slightly below, and the near-term line is only slightly above the intermediate line. So we are 1.5% above. So we'd like to. I mean, we actually did get dark green shading in a green line here. So we did get the near-term line bullish enough to get a good intermediate run started. Not the case in the S&P, but it was on the NASDAQ. And we'll see if this higher near-term low point ends up producing what you would expect, a higher near-term high point on the NASDAQ 100. The Russell 2000, of course, is not bullish, right? It was positive today, but not, a full percentage point lower than what the NASDAQ produced. And it actually produced a cluster. So as bullish as the NASDAQ is, and the S&P kind of leaning in that direction, the Russell 2000 still has short-term sentiment for now. How many days has the near-term line here been in the reversal zone? So 4 days, and the momentum line's been in the reversal zone for 5 days. And then, and over the course of those 5 days, the intermediate line now has made it into the reversal zone. So, that goes to show just how bearish the small cap index is. Not the best sign when you're trying to produce a good intermediate rally, broadly speaking, to have the small caps weighing like that. Your Dow Jones Industrial Average, which does have some, doesn't have the impact from Tesla. That's why we're not up as much as the NASDAQ. But it does have a small impact from Apple. You can see it's up today. It's still below the moving average by 0.5%. It's still dark pink shading in a red line. The intermediate line is still falling in bearish territory. The near-term line did rally up above the intermediate line. Again, has not crossed above the 80th percentile yet. So very important that we follow through today's small gain with a big move tomorrow. And again, I don't think that will happen. I think we'll probably start to fill in some of today's gap, or at least the rest of today's gap tomorrow. But if we can get a good gain heading into Apple, or at least through Apple's event, then that would be a really, really good sign for the market, especially if we can get like a bear tag produced on the Dow, right? If we can get strong enough upside that the intermediate line turns up and we get that bear tag there. All right, let's take a look at the weekly chart for the S&P. Again, we still have the green arrow, so we never did get the red arrow again last week. You notice, again, we we've got these, like we did reverse. We had a bullish reversal, though it's more of a transition because we had an upper and lower shadow. We had an upper lower shadow again, and you can kind of see, like, we did reverse from this candle, but we haven't closed up above that candle yet. In fact, we got a lower high last week. We got a lower high so far this week. We've been getting slightly higher closes, and this week's definitely not over with yet. The Hakinyashi size is below its moving average. Still positive, but below its moving average. And then PPO is falling. Even if it's still positive, it's falling, and it's off of its peak. So we have the green arrow, but we have a falling PPO. So we're hardly strong enough to turn bullish again, despite this, these gains, and despite today's gains, where we have two green arrows on the S&P. The red arrow on the stochastic still keeps us from being the green shading. We've had three green arrows this entire time on the Qs. Goes to show just how strong that one is. But we have 2 consecutive days of 3 red arrows on the Russell 2000. And most likely will continue unless we get a really big pop up in the MACD tomorrow. Most likely will continue to have. So again, it goes to show after one day of 3 green arrows, we reverse quickly to the downside and we're back to 3 reds. And the diamonds have 2 reds with only the 1 green on the MACD. So hardly the bullish scenario, broadly speaking, that we're seeing right now in the Qs. So it kind of goes to show again just how dependent we are from a bullish standpoint on these magnificent 7. Today being Tesla being the one, and tomorrow probably being Apple, the one that will try to lift try to be the tide that lifts all these other boats. All right, let's take a look at the 2-line version of this on the S&P 500. You can see we did get back above multiple moving averages. They're all sitting right on top of each other. But we closed above the 8 and 17 and the 30 and the 50 today. So, I mean, that's pretty significant. I mean, granted, it's not the biggest move. The MACD is above its moving average. The MACD is rising. You can barely see it. But the MACD is rising. It's above its moving average. It's above 0, and it's rising. So, I mean, that's all positive. That's very, very positive. The stochastics is still below its moving average. So it's not, and it's still falling. So it's not the most positive there, but still, it's better to be above these moving averages than below. So that's a decent sign, especially if we can get back above that 78% retracement of the correction pullback, right? So that we can, officially end this correction and potentially get back up to 4,800, right? And get up to new highs there. So good sign for the S&P, but again, the small cap index is not even close. In fact, the small cap index is closer to breaking the 200-day moving average than it is getting above the 30 or the 50. And it's still below its 8 and 17-day. It's still inside the value area, and the MACD is falling below its moving average and below 0. So, and its stochastics is in bearish territory. So a complete opposite picture that you're seeing on the Russell 2000 here. If you take a look at some of these other oscillators, take a look at the DMI. Again, the positive is above 25, the negative is below 25. So that's a small positive indicator right here. A slight bullish bias, but a bullish bias nonetheless on the S&P 500. Not the same on the Russell, which is still pretty strongly negative, above 25 on the negative, below 20 on the positive. Even if they've turned direction, it's still pink. You can see we're above 20 on the ADX. Looking at some other oscillators like the RSI and the CCI, we're back above 50, but not above 60 yet on the RSI. We're still above 0, but not back above this positive 100 yet. On the CCI, you can see we're still kind of right around 0 on the weekly CCI there. So again, nothing like we're not too strong. We're not bullish enough to break us out of this bearish pattern that we've been in since we broke below 50 and then confirmed it with the break below 40. We have since broken above 50, but we haven't confirmed it with a break above 60, right, to really change the trend around. So that just hasn't happened yet. And of course, looking at the Russell, you can see that definitely hasn't happened, and we're actually back below 50 and back below 0. So we're back to kind of in bearish territory here. Again, closer to breaking below 40 again than we are breaking above 60. So we're closer to being, continuing to be bearish on the small cap index. Let's look at the Ichimoku cloud. We are still in the cloud, so we haven't broken out yet to the upside. we do have a slight negative rate of change, about as slightly negative as you can be. So if we were to be flat to anything positive, we'll have a positive rate of change tomorrow. If we turn negative, then we'll be negative again. Remember, that pink shaded area is coming up pretty quick, and being above it or below it will be a telltale sign of just how bullish or bearish we're going to be. And so we're flirting with it, right? We've been below it. We're slightly above it now. We kind of need to stay at this level or higher as we get to that point, 26 days from where it finally crossed over. Your indicators down here at the bottom are suggesting no trend at all, at least on the S&P 500. On the Russell 2000, you can also see, again, we're actually below the clouds, strong negative rate of change, below both these lines, and again, no trend, but again, more bias to the downside, more so than we are to the upside, like the Qs, which are just, again, flirting with getting above. We do have a slight positive rate of change, so it's actually a little bit more positive on the Qs than it is the Russell 2000. Taking a look at the Bollinger Bands, we are in the upper half of the bandwidth. We've been kind of flirting right around the middle of the bandwidth. The bandwidth is not too low. It's been lower here lately over the course of the summer. This was about as low as it was prior to that. So it's a small bandwidth. It's not as small as it's been here recently. And then you can see the positive momentum is still gaining with the bands outside the Keltner channels, and the positive momentum still slightly moving higher, though. Again, very, very small peak so far on the momentum line compared to other rallies. So this would be a very, very weak rally as we've gone from negative to positive momentum through the red dots. And again, unless we can really push up against that upper band, we probably will get red dots here pretty soon again. On the S&P. Let's take a look at today's intraday move. Higher high, higher low. We gapped up. We filled in some of the gap, but not all of it. So we still have some, and that's why I think tomorrow we'll probably fill in the rest of that gap tomorrow, or Wednesday. I mean, soon, right? Either tomorrow or Wednesday. Sooner rather than later. We did close above yesterday's high. That's a very good sign. Small range, as you'll see in a minute. We are still inside of last week's range. So, and if you look at, it's really bearish to get a one touch after having been bearish, to get a one touch green spike to 100 and then get it right back below 70. There's been very few examples of that in the past, and they've all pretty much led to more downside. In the middle of 2018 was one of the most recent examples. If I were to go out here in time, let's see, right here is one of the more recent examples where we were bearish, a little more bearish than we were this time, but still a pullback. We rallied, just like we're doing right now. We got a one touch on the green line above 100, or up to 100, and then we ended up being more bearish, being in a correction mode. And we saw that as well here in let's see, right around 15 and 16 right there. So in 15 we were bearish. We had a one touch, and then that led into our correction of 15, and then eventually again into 16. So both of the last two times that we had the one touch at 100 on the green line were both of our last two corrections. Again, outside of COVID, but COVID wasn't your typical correction because it was just a free fall in a matter of 6 weeks. It wasn't more of a protracted, what a typical correction would look like. This is starting out with a very, very weak pullback, and what would be a failed pullback bounce, which is how corrections form: pullback, failed pullback bounce, and then more of a pullback into a correction mode as we fill in the gap between the 50 and 200 week moving averages. That's what a correction is. So this would suggest that we have our failed pullback, which is what we saw the last two regular corrections where we had those cycles, again outside of the COVID correction. And really, too, outside of the 2022 correction, where you didn't quite get that same one touch. It came close over here, but not quite. And then over here, you had more of a rally in March, where we had more. And then over here, and during June, we didn't quite get it to 100. We came close, and it was a one touch. It wasn't the day of; it was the day before. But that's we've seen this is the same kind of move that we saw right here. And so it would suggest that, again, barring a breakout in the next few days, you're going to get this below 70 and the red line to 0, and more than likely a breakdown, more likely than a break up. That remains to be seen, of course. So we'll keep our eyes on that over the next couple of days. If you take a look at today's range and volume, very, very small range, almost half of what the average is, and the average isn't that big. It's barely over 1%. Very small volume, 59, almost 60 million. Again, putting those numbers into context here, well below 1%. So we are in kind of bullish territory there on the ATR. But the volume, again, 59 million is way below the average. Again, 2.3 points on the range is way below its 52-week average. So, and then again, like I said, way below 1%. So not the kind of Monday that that would suggest we're going to get a strong Tuesday, like we saw the last Monday, up Monday, that led to a strong Tuesday on, like I said, on August 29th. Let's take a look at the volatility index today. Of course, on Mondays it rallies a little bit, and it rallied at the open. It pulled back the rest of the day, so we finished below 14 again. The VVIX came down as well, but the correlation over the past 10 days, like we really rallied last week on the VVIX, and we did not on the VIX. So I brought the correlation back below this 50% mark. This is very, the last year we've seen a lot of periods here where we just have not been very strongly correlated. That's been pretty rare going into 2021, and most of 2022. It's been really this calendar year or this last 12 months especially that we've seen so much where the VVIX and the VIX have just not been correlated. And it's been mainly the VIX, right? The VIX is a lot lower than what the VVIX would suggest, and that's why we haven't been as correlated. If I were to zoom out on this to like a very, very long-term correlation. So let's go out like, that's what, 252. You can kind of see here again. So this would be a full year's correlation on the VVIX versus the VIX. Again, it's normally very positive, right? So here's the 50% mark. In the end of 2022, it wasn't. It was the VVIX that dropped more than the VIX did. And then now it's the VIX dropping. Again, it's down there, but this time it's the VIX dropping more than the VVIX is. So again, suggesting that you'll probably get a ramp back up on the volatility index. Again, especially considering that the volatility index is really, really low. Like it's been below 90%. We've had an intermediate decline. It did not get above 95%. It did not get above its 200-day average. The VIX didn't get above its 200-day average. And it's still currently very, very low there with the 8 and 17 back below the 50-day. So it's pretty extremely low. And considering how high the VVIX still is would suggest that we have a pretty decent move coming on the VIX itself to the upside. Especially, again, as we've talked about before, but especially considering the seasonality of the VIX, which is, again, this is a low period of time for the VIX, but it's supposed to be much higher low than what we get seasonally in July, and we're obviously sitting right on the July lows. So, we're very low, especially against considering the VVIX. The VVIX, you can see, the VVIX normally is higher. It's lower than where we're at in that July low point. It's generally higher than this. And then the VVIX really ramps up into the October, is where it gets its biggest peak of the year. So considering the VVIX has room to go up and the VIX is way lower than it should be based on its relationship with VVIX and VIX3M for that matter, again, going into the seasonal run-up in volatility, we probably will get a little bit bigger of a run-up than what we would. I mean, again, it's supposed to be a high that's a lot higher than the peak we get here in September, in early September, and we're well off of that peak. So again, kind of goes to show, and it's generally pretty close to the high that we hit in March, which is again, you go back to the high that we hit back in March, we were in the mid-20s and we were flirting with the 30s intraday. So we're at 13. So that's why I say there could be some more volatility coming, and we're so complacent right now. We're kind of compressing on volatility, and we've talked about that before too. When you look at the ATR for the VIX itself being below this 10 level, we've been compressing. We've done this before. Pretty much at the end of last year, we've been compressing for a move. It's not generally, it generally doesn't stay below this 10% mark on the ATR relative to price. Not without a spike, because usually you get below it when we get these spikes, right? You get these spikes. That's when you get below that. Here's that first spike right there when we got below it, and this is how happening with it not with a spike, but just being very compressed, and that generally opens us up to potential volatility on the VIX as well. All right, now let's take a look at what's driving a lot of this price action. You can see again, past 3 months has been all about commodities and bond yields, and commodities rallying the highest return of the past 3 months, bond yields, with bonds being way lower than any other asset class over the past 3 months. Let's go look at just today here. So let's go out to September. All right, so if you look at just today alone, you can see commodities were up and yields were up, right? Bond prices, at least on a very, very long-term basis, were down. But what really helped benefit equities, especially international equities, was the weakness in the dollar. So the dollar had probably one of its biggest down days it's had for quite a while. When you look at the dollar index itself, right, it's been, well, we had a down day here at 0.5%. We were down a little bit more than that, but it's the biggest loss we had since this decline that we've seen here for quite a while. So big move to the downside there. If you take a look at what it looks like over here on the daily chart, we got all the way down to the 8-day moving average, right? And so again, here's where some of the other weakness was. And again, it's one of our bigger down days outside of, I think it was this day here. It was bigger than that, so it's the biggest down day we had since back over here when we were really falling below these moving averages. We're not falling below all these moving averages. The 30 had just crossed above the 200. And the 8 and 17 are well above the 200. I mean, there might come a time where we do retest. We've already retested it once. We might retest it again, considering the 30 is barely above and the 50 is actually still below it. But the trend has changed in a way it hasn't over the course of pretty much most of the past year. Despite today's weakness, the dollar, and that's benefiting equities, the dollar is still strong. And if you look at the 10-year yield, again back up to almost 4.3% today, up 3 basis points, up 0.7%, still rising, and a lot of that has to do with rising commodities. As you can see, up to 25, way bullish, more bullish than what we've seen in a while. And crude oil being down, but that hasn't stopped it from still being strongly above its 8 and 17-day moving averages. So still showing and well above its value area. The 50s crossed above the 200. So we are well on golden cross mode on commodities just in general. And that's, again, more inflationary than it is disinflationary, right? When you're in a death cross environment, it's disinflationary. And obviously when you're in a golden cross environment, here where the 50 is above the 200, then it's an inflationary environment. That's what it was for most of the, going all the way into the middle of 2022, into June of 2022. We've been deflationary ever since, and now we're back to it's barely, we haven't really taken off, and we haven't gotten above the value area or this 23% retracement yet, but we are back into what would be an inflationary environment for commodities, considering the golden cross environment that we're seeing there. So pretty significant move on bond or commodities and bonds. You can see TLT being down again. It's well below. It's moving. You got a little bit of a head and shoulders developing. You wonder at some point in time, falling yields has been bullish for falling yields has been bullish for the stock market, right? But at some point in time, it's not, right? We're going to be in a deflationary environment where rising bonds will be and rising bonds will rise and equities will fall, and so we are so oversold on bonds that I would venture to guess by the time it does break the 50 and the point of control, it won't be bullish for equities. It might be bullish as we get there, but it won't be bullish if we pass through there, because that would be, again, signify more of a deflationary environment more so than a disinflationary environment, which is what's been so bullish for equities. you can see the 3-month is still flat. Again, there's no movement here. We're still right around 5%. It's all the movement has been in that long term as it stayed up higher. Again, most of that because of rising inflation expectations. You just don't see very much of a change in what the Fed's going to do in September at their next meeting, which is going to be here on September the 20th, so a week from Wednesday. So they're not going to do anything there, and there hasn't been very much of a change in the November odds, though they are still pretty darn close to 50%. A little bit less, but at least still above 40. We're not out in that low probability mode where you're below 40%. And of course, going out to June, the question is, when are we going to cut rates? And like I said, a month ago, we were kind of in that 11% range, and right now that we would not cut rates. Now we're in the 32, almost in the 40% range that we won't cut rates. So that number continues to increase, and that's what's keeping the 2-year note. And the 2-year note being above 5% has not shown to be a strong bullish sign for the equity markets. It's been more of a bearish sign. You've got this big old kind of cup and handle form on the 2-year, and multiple instances of trying to bust through 5%. Once it does break through, kind of like the 10-year, getting above 4%, right? That was the big move that it couldn't get above, and once it did break through, it's pretty much stayed. That's probably what it's going to look like for the 2-year on the 5%, which means the odds of us getting a rate cut are going to diminish as we head into the first half of next year, which again kind of defeats the bullish narrative. All right, now let's take a look at how the sectors performed today. So let me bring up the sector performance here, and then just go out to, and you can not surprised to see energy being our big leader, but look at the big run up we've had in the last few days with XLY and XLC. You'll see that here, at least today, on today's move. XLY, again, all Tesla, right? Just taking off over 2.5% today. XLC up 1.5%. A lot of that's related to the same AI stuff that's boosting Tesla stock. So big moves on these. XOK still actually lagging behind the market, again with a big event day coming up. But you can see some of these other cyclical areas like materials and industrials, and then energy also. Energy was down huge today. Remember, commodities weren't down big, but energy was down big. So that kind of goes to show, again, that energy right now is a safety trade more so, and it's kind of the opposite. So when these cyclical areas do very well, energy doesn't do as well. And so that's kind of what we saw today, and what we've really seen the last few days, right? Because the market's been doing okay over the last few days. Technology, really being the weak link at the open last Thursday, but has been relatively higher since. And utilities, again, over the past, with the market up 0.5%, most of it from yesterday because of the big gap down on Thursday, but we've been rallying ever since. And a lot of it is communication services and discretionary, but it's interesting to see how utilities has stayed relatively strong this entire bout. So it's not necessarily the most risk on. Staples also, and healthcare also doing pretty well today and over the past few days. So again, not necessarily when you look at the S&P 500 and you think, okay, well, the last few days we've really been bouncing up. Not really. I mean, again, it's been mainly in a small handful of areas, not the areas that we would want to necessarily, not with all the areas that we'd want to see lead us up to a sustained rally up to the upside, and especially not the areas that are doing well over the past few days that you would think. In fact, if you look at those areas like these risk off moves here, let's go to the 12 grid. If you look at utilities down here in Staples, they were so oversold with these clusters. That's why they're rallying as much as they are. And again, you can see Tesla breaking out, or XLY breaking out because of Tesla today. XLC breaking out, to a 6% move. Those are the two biggest 3% gainer or 3-month gainers here. Besides energy, right? Energy's the only one in double digits with a pretty tremendous engulfing pattern there. Everything else, dark pink shading and a red line, right? So and those two that have been doing pretty well the past 3 days are doing that well because they were so extreme. They were so oversold going into this past week than some of the other areas. So again, not the most broadly bullish pattern that would say, hey, like we are really set here to take off to the upside. All right, well, that brings us to our trade idea of the day. So let's bring up this chart here. Let's pull up Tractor Supply. You can see Tractor Supply, after being really bullish in the early part of 2023 and the end of 2022, has been pretty, and then pulling back here in the early part of summer has been flat ever since, really flat ever since. With a small bearish bias, you can see we have dark pink shading and a red line there. When you look at the 3 green arrow chart, you can see we do have we actually do have 3 red arrows. We've been kind of flirting with that MACD between green and red. When you look at the weekly crossover chart, though, it's been really kind of sideways. Obviously, we're in a death cross environment. We have a red arrow, but we are pretty much neutral candle after neutral candle after the one big bearish candle in August. It's been neutral ever since. We haven't broken back above that body. We haven't gotten back below it. We've been very neutral with upper and lower shadows pretty much every week. Looking at some of these other oscillators, you can see that we are you get the negatives above the positive, even if they're both kind of relatively low. When you look at the RSI and the CCI, however, you can see just how neutral we are. They're both sitting right at their midpoints and have been for the past week or so. Looking at the Ichimoku cloud, again, a slight bearish bias here as we are kind of flirting with the lower end of the cloud as we've already reached the green area, have a negative rate of change. We're below the green and blue lines barely. But again, more neutral than anything is we're very like this is the 26 days plotted forward and it's very flat. We have no trend at all going on down here. So neutral from that perspective, and then looking at the Bollinger Bands, the band width has been declining as we are pretty much declining right towards the point of control over the past year. And the bands themselves have been moving in to each other inside of the Keltner channel. So we had a brief 2 days of green dots, so it turned right back to being red, and we don't really have a trend again going in either direction. Pretty decent setup for an iron condor spread. Selling the 30 delta here, selling the low 20 delta on the other side, buying one strike away, and it sets us up for a really good opportunity, with the idea being that, again, there's my break evens. Pretty much both, the whole entire value area is inside of my break evens practically, and the point of control is right in the middle, acting as a gravity pull. So we'd have to have some escape velocity to break out in either direction. So as we do, if we do, and as we do, we'll have really good opportunity for a directional trade. So it's almost like we're getting paid to put this stock in a watch list. That if it breaks out, we have a really good directional setup. But until then, I'm just going to gather some premium as we trade neutral, especially considering we don't have to worry about the earnings until after October expiration date. So a good setup, good reward to risk ratio, about the same amount of reward that we typically try to get with $1,000 of risk, but with a lot less than $1,000 of risk. So a good reward to risk setup with a higher probability trade, all with very strong resistance and support on both sides, especially on the downside. Again, and that's where I think the risk is to a downside breakout, and we're going to have a really good downside opportunity. As we get to that point, we'll have, again, it's almost like we're getting paid to watch this stock for that downside breakout until it does get its downside breakout. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.